and share the slide. Okay. Can you see the slides?
Yes, sir.
Okay. Great. So this is about till now what we have covered is how to do business globally, right? And what is global business? What are the factors to be considered for entering a market, choosing a market, right? And then we talked about your comparative absolute advantages. We talked about what is the impact of formal, informal institutions to be considered, the resource and capability framework. So this is now we are getting more into how to go about doing business. This is more execution. Okay. So we'll see. This is the learning objective, so that's fine. So I hope all of us are aware of IMF, International Monetary Fund.
Yes, sir.
Yeah. So that is basically like your global level RBI kind of authority, which basically I would say the watchdog. It provides governance to this forex. It provides certain rules and regulations to be followed, and obviously for the stability of the business. Okay. And here you would see for every currency we have this debate whether a stronger currency is better or a weaker currency, right? Sometimes we say the more dollars or the more the weaker the Indian currency, maybe the better it is because of we have most of our business from US. But at the same time, a weak currency, as Jaideep mentioned, is not a good indicator of the economy. So there has to be a balance. So there are both pros and cons to a strong and a weak currency. Here they have mentioned about the pros and cons of a dollar, of a strong or a weak dollar, right? And that's a debate which we can have. But from a business perspective, what are the factors which matter as a leader, as a as a decision maker, is what this chapter is about. So, okay. This again, so instead of the dollar, we can always talk about rupee, right? To understand what is the role of the rupee, maybe outside the US or outside India, or as the table says, the role of US outside, role of dollar outside the United States. So obviously, dollar is the common denomination for forex. That's considered a base rate or a base currency. It is supposed to be the most stable and worldwide has worldwide acceptance. Euro is another currency which competes very closely with dollar and almost has the same value because of the European Union, right? We will see what is European Union and why it is so important. And then it also is an intervention currency, right? Now, when you talk about intervention, what does it mean? Intervention. India had an intervention in '92 because its gold reserves, the balance of payments, everything was um, unmanageable, right? So it also becomes an intervention currency where IMF provides or World Bank provides loans to the country to take developmental efforts to open up the economies, right? And it is also a reserve currency. Now, reserve currency is basically the one which is not in use. You can say that it is the savings of a country, contingency funds, right? So that's even our reserve, our foreign currency or the currency reserve is measured in US dollars. Right? Most of the times when we see it in the news, the Indian reserve currency reserve is this much billion dollars, right? So that is a common way to measure it, currency reserve, and it was also obviously the vehicle currency, the day-to-day transactions um, which happen. So that is the vehicle currency which helps us, like the rupee helps us in our day-to-day transaction. You're ordering from Swiggy to Big Basket to everything. So that is the vehicle currency. So that the I would say what the intent is to establish the role of currency in an economy. So you can think of all of these things in a rupee context also. Although rupee is not a common reference, but there is a forex pegged with the US dollar. Right? We saw in the stat that it is almost touching 74 rupees now. And yeah, there is no intervention currency, but whenever we are getting a loan from an international bank, World Bank, IMF, then there is again a pegging which happens, right? And our currency reserves are also in rupees. So and we use that in our day-to-day transactions. So, as a business, if you are establishing a business outside your home country, why do you think forex matters?
So sorry, again question.
If you're doing business outside your country, why do you think forex or foreign exchange rate matters?
Because you're investing by using INR and you're getting back by using separate currency, I think.
Okay, so
Different currencies, different country has different currencies. So this obviously differs within the business.
okay. So what is beneficial if a currency is above the Indian rupee, which means like a dollar, or below the Indian rupee, which would be beneficial for you as business? Are you, if you're getting your profit in dollars, or if you're getting a profit which is, in a currency which is lower than rupee?
Profit in dollars will be better, right?
Okay. Why?
Because it has more value than INR. That's why.
Okay. Yeah. Um so so you have answered the question, but there are other factors also which govern business decisions. So it also has to do with the stability of the currency per se. It should not be very volatile. So otherwise, you would not rather have a contract based on that, pegged against that currency, right? So we talk about dollar because it is one of the most stable, supposed to be one of the most stable. Right? So we will see what determines this forex rate, the foreign exchange rate. What is why that conversion happens? Like, what are the governing factors? But before we do that, you would have heard of this term PPP, purchasing power parity. Basically, what it means is if you have to buy, McDonald's Big Mac in India, as opposed to buying the same McDonald's Big Mac in US. So what is the difference relative to the currency? For example, in India, you might spend 100 rupees, but in US, you might spend maybe $5 or maybe $15, whatever, right? So in relative terms, there is the Big Mac is cheaper in US as compared to India. Right? So that is the purchasing power parity. It is also sometimes referred to as the cost of living in the local condition, right? So there is a Big Mac index. Where is it? 1 second. Yeah, can you see this? This is a Big Mac index. Basically, it has been pegged against the price of the Big Mac in US, right? The dollars that you have to pay, and the similar amount that you have to pay across these countries, and what is the difference from US in relative terms, right? So if you see Brazil, it is more expensive, whereas in China, it is half of the price. And this is all relative to US market. So what is the difference? So that is what purchasing power parity is. Okay. You can as well make our own, we can always make our own index. You can make our own idli dosa index also. It is very much possible. The cost of buying a dosa in Bangalore versus the cost of buying a dosa in US, right? So maybe in Bangalore it is available for 10 rupees, but in US might be for $10. So that is the purchasing power parity. Any questions? Any questions?
No, sir. Okay.
Okay, generally there are, so that's good. So the purchasing power parity is one of the parameters which basically determines the foreign exchange. Obviously, then the interest rates from the bank, right, from which you are borrowing, the money supply. Right now, you would see that the rates of FD are going down, whereas for investment, so it is being encouraged to invest, right? You are in maybe share markets, in capital markets, yeah, and we are being encouraged to spend, right? And then the productivity and balance of payment. So the balance of payment is what we have actually referred to before also, which is the trade surplus or the trade deficit of a country. How much are we trading in and trading out? Right? So India had a very extreme negative balance of payment in 92. Right? And the exchange rate policy. So sometimes governments intervene in the exchange rates to decide the exchange rates, whereas in other countries, maybe like in US, they don't intervene. Let the market forces decide the exchange rate. And the last one is the investor psychology, and that plays a very important role. You would have seen that in companies, buying or selling of shares, if there is a sudden selling which starts, everybody starts selling it, right? And at the end of it, maybe nobody knows why they are selling, but just because everybody is selling, they also start selling. Same thing happens with currency also, right? So investor psychology is as important. And all these factors, they basically decide the supply and demand. Now that is what is the exchange rate. The demand for a currency and the supply of the currency is what determines the exchange rate. If you treat currency as a product, then you can apply the simple demand and supply rule from the economics to this. So in that way, you can say the currency which is most in demand is the US dollars. That is why it is considered to be the most the common denominator for exchange rate. Okay, no problem. Thanks, Jaydeep. Okay, any questions here? No questions? Okay, thanks. So we just saw the live version of this on the Economist webpage. So this is the same table from a snapshot of a currency exchange rate few years back, I think, few almost a decade back, right? So here we were talking about the Big Mac index. Similarly, I always say this to all the batches that we can always develop our own, idli dosa index and peg it across countries. We can index it, and that would be our Idli dosa index, and that will be an indication of the purchasing power parity. Okay. um, has this topic been covered in some other subject, the balance of payments and related to forex? Has it been covered? Anyone? Uh, Amol, has this been covered, this topic already in some other subject?
Yes, sir, it was part of account in
Oh,
first trimester, I guess. So it will be better if we refresh it.
yeah, but that's where I just see, limited questions. So that's why I was just thinking that there is certain familiarity. So that's fine. Thanks.
Because most of the people are not from commerce background, so we're habitual to forget it,
Yeah,
maybe.
yeah.
So
Same here. uh, so again, going back to the balance of payments term. So it's, you can consider the balance of payments at an individual level basically as the amount that you get versus the or subtracting the amount you spent. So that is the balance of payment for you. So same thing, same is true for the country, right? The amount of exports uh, and the amount of imports, they decide the balance of payments. So if I am exporting more and I'm earning more from the exports, and I'm importing less as compared to the exports, my balance of payments would be positive, and which is a good indicator, economic indicator for the country, right? And there is this, you know, direct formula given for one current account balance for a country. So the balance of trade plus what is the income from abroad, plus maybe people living outside India, right, who are transferring money, like especially from Middle East or US, then that becomes another source of the current account balance. So this constitutes the current account balance for a country, right? And this is a simple balance of payments view. So there's a credit and a debit. Uh, don't have to worry about the how to make this table. So you don't have to worry about that. You can just relate it to the bank statement that we get, right? You just go online and check your mini statement or bank statement where you have your debit and the credit or transfer or deposit and withdrawal from different set of activities. So exports of goods, imports of goods. So balance on goods is something which is negative. Then services, same. Then the overall balance on goods and services. Then there maybe there is some asset ownership in some country or an income from that. Like that, there are these different parameters which constitute the current account, right? And then there are some different parameters which constitute a financial account, and that's the, I would say, the most simplified version, although it's very, I would say, complex, but this is very simplified view of a country's balance sheet or balance of payments. Okay, so when we talk about exchange rate policies, we just discussed that exchange rate policy can be either free floating, in the sense it can be determined by the market, or it can be government driven, right? So when we say a floating or a flexible exchange rate, it is basically government says let the market decide what is the exchange rate. India has a floating exchange rate, but at the same time, government also starts buying or selling depending on the extreme conditions that happen in the market to correct or to make it keep it viable, to keep the currency viable. So that's where the clean or dirty float happens. Clean is basically there is no government intervention, whereas dirty is there is selective government intervention, which is you can treat India as a market for that. Right? The fixed rate is the opposite of the floating, which is uh, government decides exclusively what should be the exchange rate and manages that very much, I would say, openly, or declares that it will manage it. So classic example can be China, Russia, where the government keeps on buying and selling their treasuries to keep the exchange rate fixed. Okay. Um, it is not a free market. It is not an indicator of a free market, right? And I would say every government, again, here we are talking about government, not businesses. Governments have a certain band which they feel comfortable that the country should have the exchange rate as a range. So if it is going up or down, then that is where government intervention is likely to happen. Okay. Then we also mentioned about the we saw that factor investor psychology, and we talked about the effect sometimes which happens in buying or selling of shares. So if a company if a investor starts selling, the others also start selling. The actual investor might have a logic to sell, but the rest of the people may not. They would just be following somebody else's actions. So that is the bandwagon effect, where you are just simply following what others are saying, which is what results in capital flight. In between, you would have quite a few years back, you might have heard that people have started withdrawing from ICICI Bank, and then almost everybody started withdrawing. That the bank is not stable. Everybody started withdrawing their money. So that is kind of a bandwagon effect which happened, which led to several people withdrawing money, which is capital, from the bank. So that can happen at a country level also, where the investors can start selling off the investments in the businesses of that country and can result in capital flight, which is the foreign institutional investment can start declining. Okay. Any questions till now? I'm moving a little bit.
No, sir. No.
Yeah, I'm moving a little bit, faster, because these are mostly what kind of terms that we are talking about. Not much to do with why or how right now. We're just getting into the terminology. We are learning the glossary of the forex.
I guess these all are definitions, right?
Yeah,
So
yeah. These are the glossary definitions. So yeah, from a exam perspective, you can consider them a good candidate for your short answers. Uh, I hope everybody is aware of gold standard, which used to be the most common, where the value of the currency of a country used to be related or correlated with the gold reserve that a country has. Right? So that used to be an old standard, right? But slowly over a period of time, there is something called a Bretton Woods system, which started where the US dollar became the standard against which every currency started getting compared or getting pegged. Right? So now a company, sorry, now a country need not have the currency reserves in proportion to the gold standard. That is, or the gold reserves. That is no more followed now. Not even Bretton Woods is followed. So when I think President Nixon, he actually even decided to do away with the Bretton Woods also. So there's right now nothing, no common system across, but we treat US dollar as the common denominator. So that's where we see post Bretton Woods, which is a flexible exchange rate regime, which is what we do right now, right? The common denominator here is US. Yeah, in the IMF, obviously, the founding countries, like in any other setup like UN, they have a certain weightage. When you say weightage, they have a certain when they speak, there is a certain weightage given to their perspective, and that is what is also true in IMF. Although it is a neutral authority, it is supposed to be a neutral authority, but definitely there is some level of weightage. Like in your International Cricket Council (ICC), when BCCI says something, it is given a due weightage because it is the largest revenue provider and the biggest in the ICC. Right. These are some of the activities of IMF. Again, I would say this is more historical, right? And this indicates like the amount of bailouts, the value of bailouts, which has been given to different countries by IMF. So you would hear that generally in the news about, especially on the um, developing or not yet countries which have not yet started developing. There are bailouts given by IMF. So IMF is also evolving, right? IMF one was more, I would say, interfering. They would, tell the governments to stop spending. They would raise interest rates, right? And which would result in inflation, right? IMF two actually is more about stimulating the economic activity. So they do encourage, they do bailouts, they do give loans, and they are more focused on fiscal policy as compared to monetary policy. So these are two very different aspects of controlling the or levers of economy. The fiscal is more to do with taxation, monetary is more to do with interest rates. Okay, so they are now more focused on taxation. And if you see the money part becomes easier, and that is their target, that consumption should increase. And if the consumption increases, obviously the more tax gets generated, and which is what they encourage, and they get back their loans also. Okay, so till now we were talking about countries, okay, and institutions. Now we will talk about businesses. So what are the business elements to this forex is what we'll touch upon. Now, as a country, as a company, what can you do? What are the things that you can do to manage this forex? Is what the next set of slides are about. Okay. So forex market is like any other market. I think that's another definition, like Amol mentioned, right? Now, what companies do is, for example, I'm or this is also especially true for the financial companies, and they're very well, I would say, this is a very old way for them to operate, where you would enter into a contract with another company or with your own with your own within your own company across a different office, maybe one office in India, the other in US, right? So it can be within the company, it can be outside the company. A US company entering into an Indian IT contract with an Indian IT company, right? So what they can do is they can just say, okay, whatever is the rate on the given date time is what would be the exchange rate. So that becomes like a very spot transaction, very I would say a one-off, right? But that is not how it happens. What happens generally is they'll say, okay, our contract is for 1 year, so whatever the rate is on that day of the contract where it is getting matured, we will consider that exchange rate, or the exchange rate as of today. Today's exchange rate would be considered to pay whatever for the services that we are consuming. So it can be a forward. That's what is a forward kind of a transaction, where you are considering something which is fixed. You fix it. You say that as on date, whatever is the exchange rate. So you basically reduce your risk, okay, and uncertainty of the currency because of the currency movements, okay. And hedging is basically investing in multiple currencies. So one investment you'll do through rupees in some Indian company, the other investment you might do in a currency which is moving opposite to rupee. So in your portfolios, for example, you have your equity and debt, right? So generally invest your financial advisors will say you should have a mix of both, or you should invest in gold as well as shares, because they move opposite. So that is what is hedging. So you are basically saying, I'm not investing everything in one, I am investing it across so that my risk gets reduced. Okay, so there's something called a forward discount and a premium. Now, for example, I'm executing the transaction on a spot rate basis, but what happens is on the day where the payment has to be done, right? The currency has risen, okay, and because you did a spot transaction for that particular day, you're not able to actually realize the benefits of that. So a simple example, you bought maybe today you bought $1, it is maybe 74 rupees, and then you say that, okay, I'll sell it at 74 rupees, okay. But when you are selling it maybe 1 week after, maybe it is now 80 rupees, but still you have to sell it at 74. So you have a 6 rupee discount there. So that is a discount. At the same time, if you got it at 74 rupees, and the currency is at 60 rupees 1 week after, so you get a 14 rupee premium, right? So that is the discount and the premium here that we are talking about. Most of these terms that we are learning, or the strategies, are for financial companies. So generally when you talk about business operations in other categories of companies, these are confined to the finance department, okay. And that is not very frequent also, business operations wise, right? They would generally have a fixed rate, and they would internally, especially among the operations, they will not deal into these aspects. A legal contract will not have these aspects. This is especially true for financial companies. Yeah, so currency swap is another way to manage risk. See, all this is basically being done to manage risk. That is the underlying factor, to reduce uncertainty and to manage risk. So whatever we have learned, if you get a question in the exam saying, okay, what are the ways you can de-risk, your currency fluctuations, then these are the steps that you have to follow, or this is how you should respond. Okay? So the one of the steps is a currency swap. Now, currency swap is basically you exchange dollar for rupee and rupee for dollar. That is how it will be, and you can decide what is that barter amount. Okay, and at a particular point of time, you do the exchange, and then you exchange it back, because you are generally dealing with your home currency. So you exchange your home currency with the foreign currency at a particular time, and then you say, okay, maybe after 6 months I'll do a swap. Okay, so this is again to do a transaction, to de-risk the transaction. So it makes it independent of the fluctuations. You have exchanged it. The exchange basis can be decided on maybe the current day's exchange rate, or it can be decided on the forward exchange rate, whatever we saw before. Okay, yeah, these are quite straightforward one-liners, so I don't think I mean, there's a need to kind of discuss much about it. So basically, when you go to a bank and you want to buy currency, for example, you go to a Indian, maybe an SBI, and you want to say, okay, I want to buy dollar. So that is what is the offer rate. Bank will say, okay, a dollar is costing this much. Then the other way, which is basically you want to sell it to the bank, then bank will say, okay, this is the price I'm willing to buy. So buying and selling is the offer and bid rate, and the difference between the two is the spread or the range. Okay. So we just talked about this. The entire game for business to deal with forex is to reduce risk, the currency risk. Okay, whatever as a business you do, you talk about reducing risk, and that's why you have to factor currencies, so that the fluctuations in the currency do not result in additional risk. So as a business, you will do some level of maybe hedging, right? You will again, the classic example, as an individual, you do investment in gold and in stocks because they move opposite. So and either ways, you are benefiting in at least one place. Same thing you will do as a business also. You'll do strategic hedging, right, into different currency zones. Yeah, so currency board is again something that a monetary authority. It can be our this one RBI, right? It can be the Federal Reserve in US. So anything which is basically which provides currency which can be exchanged. Okay, so that is what that monetary authority is. Right? So yeah, as a decision maker, as a leader, if you're managing a business unit which deals with foreign markets, then you need to factor the risk of forex. Okay, and you have the options of currency hedging, strategic hedging, or both, or the ways that we have discussed. And more than that, it is the country with which you are dealing. So the stability of the country, the economic indicator, which is what Jaideep just had mentioned in the beginning also, is the economic indicator of the country. So you need to factor those while dealing with any foreign market, or making any contracts, or deciding a monetary value to your contract, right? So these are the factors that you have to consider. Any questions?
No, sir.
Great. So this is a short and sweet chapter that we are done with. Let us move to the next. So now that we know about the currency fluctuations, uh, we'll talk about global and regional integration. Again, the core reason for currency fluctuation is to manage risk. So this is also to do something on the same lines. Okay. Um, what do you get when we talk about global and regional integration? Any idea? What is global and regional integration? Or what might be global regional integration? Anyone?
Collaboration with foreign countries in a global business other than India.
Okay. On so you're talking about a business level. Okay. Thanks. I think the class is particularly silent today. Anyways, we'll move forward. So when we talk about regional integration or global integration, one of the key elements is, if you think about the three fundamental variables, right? One is geography, the second is the people, third is the businesses, which is the dollar or the revenue, right? So this here we are talking about the country level, which is the geography level, right? So we will see what are the benefits of why this global integration is thought about as a concept, and what is the reason behind it, and what are its pros and cons. Okay. Now, the case for economic integration is because it reduces barriers and costs to global trade. Okay, and trading between the countries, trading among a group of countries. That is why there is this concept of global economic integration. Okay. So there are different, I would say, levels of integration. Here we are talking about economic integration, and again, this is more to do with definitions or just knowing the historical perspective. So there is a general agreement on tariffs and trade, which is basically an agreement between among many countries. There is also the WTO, World Trade Organization, which is the watchdog for the world trade, but it is being disbanded. Maybe a new institution might be coming up there, right? Um, yeah. So this is something they have mentioned, the contraction of world trade during the Great Depression. So the world trade is key to keep the global growth going, right? In the current conditions, and even in in the projections, it is being said that the global trade might contract, right? It can be because of the reduction in the dependency on foreign markets, right? It can also be new supply chain patterns which are emerging within the developing countries. When Mr. Modi says vocal for local, it is also on the face of it, it looks like, okay, we should not talk about global, but it kind of gets in line with making products for the world, making better products for the world, right? So global trade is a key indicator of economic development across the countries. So if the global trade is reducing, which means the economic activities are reducing, right? So these are the, I would say, this is the positive of it, the benefits of economic integration. So you have a enemy country, you start doing business with it, you'll have peace, relative peace with it, right? Because you are exchanging products and services and revenue, right? So there is a political benefit to it. Obviously, there are economic benefits where the cost of doing business reduces, the movement of labor, the movement of transportation, freight, all those things becomes easier. Customs cost reduces, right? So that is the benefit. So the pro side of it. Okay, we'll also see the other side. Yeah, we just okay traded. So the previous one was GATT. This is GATS. Okay, which is about services, and then there is another agreement called TRIPS. So you'll see several agreements in this chapter. This is more to do with knowing what the agreements are. Okay. Yeah. So that's, I would say, the overall structure and the governance that WTO provides. Um, there are the goods, the services, and the IPA. So it helps in managing disputes if there are any across these, right? And it basically tries to maintain transparency across the trade, services, and the intellectual property. These are the three key components for WTO, and it's a governing body. Yeah, so that is the key part. WTO does not have enforcement, which means it cannot give directives for a country to a country to follow. If the country disputes what WTO is saying, it can actually the country can simply go into International Court of Justice if it doesn't agree to WTO. But it is more a governing body more than anything else. Then there was some Doha round which happened in 2001, so which is kind of quite old and may not be very relevant. So they keep on having these negotiations of contracts among countries. In the Doha round, they decided to kind of negotiate on the subsidies on agriculture, tariffs, and IP, right? And 2006 it couldn't happen because of disagreements among the countries. So this is more factual is what we are covering right now, right? Now this is what is the interesting part of this chapter, where we talk about different types of integration. Okay, now we have the basic integration is just a free trade area. Free trade is basically your taxes are kind of removed, and then the next one is the customs union, so where the tax is also removed, but also your external, the other countries taxes are also removed, so you can see the properties of each of them here. Okay? So the tariffs are removed, then external tariffs are removed, then there is free movement of people also, goods also. So this is cumulative, huh? Each of them constitutes this. And then the ultimate is a political union, which is the entire political setup is also integrated. So any example of economic union? Anyone aware of economic union? Any economic union? Anyone on economic union? A place where you have free movement of goods, people, services, capital.
European Union, EU.
Yes,
European Union.
European Union is the classic example of economic union. Any example of political union which happened historically? So political union happened in your East-West Germany when it was divided in 89. the political union was formed back to combine Germany into a single entity, right? That is one of the few countries which was split by the Western powers and was able to politically unite. Right? You have South Korea, you have multiple instances where countries have divided. India itself, right? They haven't been able to achieve political union, right? But Germany is an exception. Now, if there are so many benefits to an economic union, why do you think Britain exited EU? If it is so good, why does Britain want to get out of it, or why did it get out? Anyone? Oh, okay. Firstly, I hope you are all aware of Brexit. So Britain exited the economic union.
Yes.
So why is the case? If it is so good, economic integration, why do you think a country will get out of it? Okay, that's a question that you can search about. Why did Britain exited EU? Yeah, so whatever we saw in the previous slide is what is explained in the next set of slides. So the economic union, the monetary, the political, the FTA, free trade area, customs union, and a common market. These are the types of the regional economic integrations. Okay, and each of them provides a certain economic benefit. Basically, again, the idea is to enable global trade. So how can you remove those barriers? That's why all these kinds of integration are suggested as concepts. Okay. This is more about the next slide. Maybe about 2-3 slides would be about the history of EU. So this is again more fact based. Okay. Anybody who has visited the EU would have gotten a Schengen visa. Basically, once you get that, you are able to travel around the EU countries, and it has a currency, right, where that currency can be used across all the countries, which is euro. Right. These are some of the countries which became a part over a period of time. These were the 6 founding members. UK joined in 70s and then exited. Right. Yeah, so it kept on expanding. It reached around 16 countries. Right. Here is where it kind of indicates what might be the good and the bad of, or the pros and the cons of adopting a common currency of an economic union, right? So obviously, what we saw in the last chapter, there will not be any conversion or currency forex, because you're dealing in euro. Everybody is dealing in a common currency. That facilitates a lot of direct price comparison. It reduces any uncertainty, right? And then uh, it helps the governments to, or the EU body, to impose monetary discipline on individual countries, right? And the cost is basically that you lose the fiscal and the monetary independence. Okay, you are not able to take, as a government, you will not be able to take monetary and fiscal decisions. And that is one of the reasons that Britain exited, because they thought that it's a question on their sovereignty, independence to be able to take these decisions. So people voted not to be a part of it because they were not able to form their own policies. right? Italy, once it actually violated the EU policy and was penalized, and had to pay a fee, penalty to the European Union body, because it was not able to follow the monetary policies. So that is another side of economic integration. And yeah, for the British, costs were more than the benefits, and then that's why they exited. Right? So this is what is the challenging side of an economic union, or a European Union as an instance. Right? Um, Obviously, the next thing is the political integration. So do they become politically a single entity, right? Which country gets higher voting weightage, right? Are all the countries equally given equal weightage, right? Where to expand next? They already have covered the EU. So you know, how do we expand? How do we grow? um, Labor and immigration, not only within but out from outside, is another big challenge. Countries within EU, they become protective, and then they discourage also global trade. And Greece is a classic example of the financial crisis and recession. So Germany ended up paying a lot of bailout money, because it was one of the most developed countries in the EU. So it had to give the most a contribution to the bailout money being given to Greece. So that is another challenge. Right? So these are some of the issues from with an economic union. Now, this is towards the Americas. Till now, we are focusing on Europe. So you would have heard of NAFTA and all because of Trump right now. NAFTA, FTA. So these are different agreements within the Americas, which is the North and the South America. The countries within North and South America. So you'll have NAFTA, FTA, you have CAFTA, right? You have this Union of South American Nations. So there can be geographical integrations or trade not promotions, trade agreements between the countries because of their geographical proximity, or because of their common political beliefs, or because they just want to do business, they want to exchange, they have complementary set of products and services. So this is more geographical. We are talking about Americas. So the moment you say Americas, it is more geography, more than anything. Then this is another geography, which is APAC. So you have ASEAN, which is becoming more and more prominent. We have APAC. Then there are several in Africa also that they have mentioned. So these are some of the regional economic integrations. So this is Africa. Okay. Okay. Again, as a business, what do you do out of all this information after going through all this? So you need to understand, when you are doing business, whether your country has an agreement with your the country with which you are planning to enter into. If there is, it helps, right? If you are in Italy doing business with Spain, then it becomes easier because you are part of EU. But maybe if you are in Italy, and you want to do business with maybe US, it may not be such a direct, or ease of doing business might be, ease of transacting might be difficult. So those are the things that again reduce the risk, they reduce the cost of business, and they help you set up the business quickly. Okay. So while deciding to expand, this becomes a key criteria. If there is a level of economic integration between the markets, then it helps the business to set up their operations in those countries. Any questions? No questions? Okay, great. So we are actually going a bit fast today. So we will move to the next chapter. Let me just reshare the screen. Can you see the screen?
Yes, sir.
Yes, sir.
Yes, sir.
So I think the chapter 7 and 8 were more about, I would say, knowing facts uh, and establishing maybe a global, awareness of the global variables like forex and trade agreements. Now we come back to business. Okay. Uh, any examples of wait? Okay. What do we understand by entrepreneurial firm? What is an entrepreneurial firm?
So that basically getting new products to the market.
Okay. Yeah. So nowadays it's generally called a startup. Right.
Yeah.
Any startup firm in any area, it need not be technology, right, is an entrepreneurial firm. Every firm has this journey, right? And whatever, global brands, they were local ones, as Mr. Modi says. So that is the journey that most of the brands or companies take, right? So if you are an entrepreneur, if you are starting a business, how do you go about globalizing it is this chapter about. Now, what do you think, what do you mean by entrepreneur? What is the understanding? I mean, what is, anybody can share what is their perspective of entrepreneurship? What do we mean by that? Anyone? Bangalore is like a startup hub, so I think anyone can share their perspective. What is entrepreneurship? Okay. Entrepreneurship is about commercialization. Basically, that is the scope of entrepreneurship. Is basically how to generate revenues out of opportunities which were present and were not fully, exploited, or which were not even identified before. So that is entrepreneurship. It's about setting up business. Right? Now, entrepreneurial firm, you can always relate to a startup, right? It can be a completely new startup. It can be a startup within a large organization. Nowadays, they have these innovation labs and all. Can be that, right? So, and entrepreneurs can be a part of these big organizations, or can be their own, on their own they can start, right? And the international entrepreneur is basically that, has businesses across different markets. So your Oyo is a classic example. Ola These are all Indian examples that we are giving. So, and we use products and services of many international entrepreneurs. So your Uber, your Google, Facebook, these are all global entrepreneurs who have been successful, right? And yeah, SMEs are basically uh, companies which have fewer than 500 employees by strength. If we see fewer than 500 employees, sometimes they're also classified by the revenue. Okay. Now coming back to our two parent frameworks, two fundamental frameworks, institution and resource based framework. Every entrepreneur has to factor these two, right? Formal and informal institutions that the entrepreneur has to interact with, and what are the resource capabilities that bundle up together to deliver value, right? So the external environment and the internal capability, how is it helping the entrepreneur to grow, to innovate, to get money, and to globalize? That is the next set of slides. Uh, before we get into that, anybody wants to share what might be the, you know, when you are globalizing, like for example, Oyo globalized or Ola globalized, maybe to US, sorry, UK market. What would be the factors, formal and informal factors or institutions that they would have to interact with? Okay, let's move. Yeah, so as an entrepreneur, you'd always look and understand. This is where our previous chapter comes into picture, right? The ease of doing business, right? If you know that you have a certain agreement with the country you want to enter in, and its ease of doing business is high, right? Then you would rather prefer that country over others, right? So you would rather enter Singapore rather than a Niger or you know, any of these countries, right? That can be a factor in your decision making, right? And simple things like getting electricity, you know, if you're establishing an office or a factory, it becomes um, one of the fundamental utilities to set up and get your operations running. So these are the factors which actually on ground impact the ease of doing business, the attractiveness of the country, right? Now, how do you grow a firm? You have some levers, right? Uh, now, if you would see any app, an app is measured by the number of users, the user base, the active user base, right, and its growth. So in the Google Play Store, you would see these many downloads. So that is a key indicator um, of the growth of the app, right? Similarly, for any firm, growth is one of the most important indicators. Innovation is another factor where what is the unique thing? If you go back to the resource based view, what is the unique thing that makes it hard to imitate, right? And then obviously you would need a certain level of financing from banks, or that is where the formal institutions kick in, right? And you might apply for a loan, and the bank will evaluate whether it is, what is the risk that they are taking by giving you loan or by giving the company a loan, right? So that is, these are some of the factors that help or these are the characteristics that help the entrepreneurial firms you know, in their growth, or this is how you can identify whether a startup is growing. Okay. And as a concept, this microfinance was introduced to enable entrepreneurship to enable people at every scale to be able to come out with innovative ideas and set up their own companies. So that's where you have loans as low as $50 you can get to start your business under a microfinance scheme, right? And there are microfinance institutions, especially in South Asia, Southeast Asia, which do that. Now, talking about financing, one of the sources of financing is the venture capitalist, right? And we have many in Bangalore, right? This basically talks about what is the investment of VCs as a percentage of GDP, which is a indicator of the amount of startups that you have, and also indicator of the intellectual ability or the intellectual capital of a country, right? So if you see, um, in Sweden, in South Africa, it is some of the highest, 0.3% of GDP, right? And this is the informal investment, whereas venture capital is very formal. There are contracts, everything, right? This is the informal. Informal is to do with family or community. Now here you see China is the highest, 5% of GDP, right? Now, if you remember the Hofstadter's dimensions that we discussed earlier, uh, this is some relation with that also. The formal and the informal institutions of a country, they impact the the entrepreneurial characteristics, the behavior of people, and countries where it is encouraged, there you will find more startups or more businesses. Countries where it is discouraged, you will find lesser. The encouragement or discouragement can be through formal institutions. So banks will not give loans, that is formal. Governments will not give subsidies, but it can also be through informal. Your friends, your family, they discourage to start a business. So that is another impact of the formal institution, right? So this is what comes out clearly in the uh, two graphs. Yeah. Now most of the your digital firms, your app-based firms are born global by default. The moment they make available their app to a Google Play Store across the globe, they are actually born global firms. Okay. You can stop me wherever you have any questions or clarifications. Okay. Now, this is all about entrepreneurship. Now, how does an entrepreneur enter a foreign market, right? So they can directly export their product if they are manufacturing something, if they are producing something. Maybe, for example, Tesla is producing cars. Tesla can directly export it from US across the market, right? They can also give licensing. It generally happens in software. So Microsoft gives licenses for their MS Office. So that is licensing, and then they get the licensing fee out of it. They can also franchise. So McDonald's is the classic example of franchisee. Again, you should think of the scenario where Microsoft started its business and got into this licensing mode. McDonald's started with one outlet and started franchising it globally. And this is called actually the stage model, where you can actually decide, rather than going big bang, just to understand the risk of for the market, just to test the waters of the market. You can actually follow a step-by-step model instead of going big bang. So what would be the step-by-step model? It would be basically, maybe just I would do some level of export, see how my product is getting adopted. If it is good, I would start maybe my own manufacturing operations there, or I might license it, my IP, and get some royalty out of it or licensing fee out of it. Like that, you can have a step-by-step response, right? And this figure class is a classic, I would say, flow of information and documentation for an import and export transaction, right? So it is between China, Bank of China, and Bank of America. Now, a startup company is trying to export from US to China, right? So the startup company reaches the approaches the Bank of America. Now, also it has a shipping arm because it needs to ship it to China. But for that, it needs a letter of credit. So the shipping documents which this exporter gives to Bank of America are shared with the Bank of China, right? Which issues a letter of credit. These are very formal processes, right? And from there, the process starts, okay? And once there is a letter of credit issued, then the the shipping or the logistics part starts, okay? And you can see the flow. The letter of credit is basically getting circulated across here everywhere, right? Shipping documents are circulated across. So once it reaches Bank of China, then it comes back to Bank of US, right? And then the merchandise is coming from US into China, okay? Sorry. Yeah, so you can also do indirect exports where there are aggregators who take your product along with other products, and then they sell it to the foreign market. So your risk is reduced even more. Okay, you're not even involved in direct exports. So that is also one option. It can also be through an export intermediary, which is what we just talked about, the middleman, right? So this is again to reduce risk or exposure to a foreign market. As a startup, you are very sensitive to risk. So if you have to mitigate that risk, you can follow the different steps that we discuss. Indirect export through an intermediary, or direct exports, or licensing, right? Or this one, franchising, right? uh, these are all in increasing magnitude of risk. The more you expand, the more you can take risk, right? So that's how you can approach as an entrepreneur. Now, if you are an entrepreneur, these are some of the things that you have to factor. That's what we have learned, right? And the formal and informal institutions are key to startup ecosystem, right? We have Government of India supporting startup ecosystem. We have banks supporting startup ecosystem. We have now slowly we are having a culture of encouraging people to think about business, to be entrepreneurs. It is encouraged. It is seen in positive light if somebody is doing starting their own business, right? So there is both formal and informal, right? And while globalizing your business, you can take those step-by-step process that we just discussed. Any questions? Any questions? Okay. So we are actually today moving at a good pace. Let me just. Okay, so we just finished the 9th chapter. It's 3:08 right now. So maybe can we meet in 10 minutes? Maybe 3:20. We can restart. We can pause for 10 minutes. Yeah, so we'll come back at 3:20 and we'll cover the next chapter. Thank you. Hi leaders, I hope you're all back. We can start with the next chapter.
Yes, sir.
Yeah, thanks. Okay, so last chapter we talked about how an entrepreneur can expand business globally, right? What are the steps that can be taken to enter the foreign market? Now, once the decision is done to enter the markets, this chapter talks about how a different level of relations or partnerships can be made with foreign firms. Okay, so and what are the factors that have to be considered while entering a foreign market? Okay, so you would have heard of Patanjali making this claim that they are a Swadeshi company and rest are outsiders. So we make we help make money for the we help the foreign companies to make money, and if you buy Patanjali, uh, you're keeping the money within the country. It's a Swadeshi brand. So that is the liability of foreigners which any company coming from outside the market has to deal with, right? Because that is they are foreign to the market. Um, any company entering Indian market has to consider that they are an outsider, and that's where you see different kinds of campaigns, advertisements by companies like Amazon and all trying to localize, and some of the companies have excelled in that, and so much that we think that it's an Indian brand, right? Like Colgate. If you go in the village areas, you'll you'll see Colgate very much available there and in use, and most of the people perceive that it's Indian, right? So that is the liability of foreigners that companies have to deal with. They have to invest in marketing campaigns to overcome that, to make people aware if it is a consumer brand, right? And that's the additional cost of doing business. Again, when you are deciding to enter the foreign market, you have to consider the formal institutions that you have to deal with and the informal, which is people, culture, right? And also, actually are you delivering in terms of value? What is your resource capability, the Brio framework? What is it which will differentiate your firm from other firms in the country, right? So those questions you have to ask, and then decide when to enter, where to enter, and how to enter. Yeah, so we just talked about this, that when you think from a resource-based framework, you need to invest, deploy overwhelming resources to offset the liability, which we talked about, right? Like Amazon positioning, saying Amazon's market campaign, what advertisements they say it's a "aapki apni dukaan," right? So they are investing heavily, and actually they are not making any money, but they are investing heavily just to overcome that liability of foreignness, right? Then there are location specific advantages. I think we covered this in a different form before, called Oli advantages, right? So that is location specific, where you decide to enter in a city like Bangalore because of maybe a combination of the I would say subsidies given by the government, the talent pool available, right? And the facilities available, the electricity, water, everything, the infrastructure. So a combination of location and agglomeration specific advantages help you understand where to enter in a particular market, right? So these are some of the strategic goals that you need to factor, where you can decide which dictate on that how to enter a market, basically which particular location to enter, right? So if you are an oil company, natural resource seeking, or a mining company, right? You need to be located in exactly those places where those resources are available, right? Which is here the example is oil. Market seeking, so you talk about a consumer base, so maybe that's where Amazon saw a consumer base in India, so then they entered India, right? Here example is seafood in Japan. Efficiency seeking, low cost labor. Most of the supply chain of the world is in China because of low cost. Innovation seeking, where you would rather you know prioritize new thinking over cost. So you have the Silicon Valley. Bangalore is also mentioned here. So you have these priorities basis which you are taking these actions, where to enter, and then you are entering those markets. Okay, so that is the where to enter part. This is just example given of the manufacturing cost of China. If you see compared to US and Mexico, how different is it? So that's where China has a cost advantage. But at the same time, if you see, it is also increasing in cost. Within 3 years, it has risen by $8. So that's where India comes in then next. So they will start evaluating other countries. Right? Um, yeah, so this is the informal side of that market entry, which we, which we talked about from a institutional framework. What is the difference between the cultural dimensions of the country? So that is the cultural distance, it is called. So, there can be power distance, there can be individual versus group, those kind of dimensions which can be looked at. So in a country like China, group is preferred, group or a community effort is preferred, as compared to US, where an individual can run everything. It is believed that an individual should do everything, right? So they are very opposite, but they still do business, right? Then there is the institutional distance. US is a democracy, whereas China is a communist, also almost a dictatorship, right? So how much difference is there, or how much similarity is there, is the institutional difference or distance, right? That is where in order to maintain or manage the risk at every step, there is a step-by-step model which businesses can follow. This is similar to the one which we saw in the last chapter. Okay. um, so when to enter, we are talking about where to enter. When to enter, it can be you might be the first firm in the country to enter, or you might be not the first firm, maybe third or fourth firm. So both sides have advantages and disadvantages. If you're a first mover, you create your own consumer base, and you can understand the market better, and then create a lot of traction, which and raise barriers to entry for other companies. At the same time, if you are a late mover, you know the mistakes which the first mover has done, and you can actually accelerate your learning process and enjoy the benefits. So yeah, here and this is a classic question which comes in the exam, so it's an important table from exam point of view. Here both first and last mover advantages are given, right? So for example, you can establish your leadership, you can start using resources which are scarce, you can raise entry barriers for others, right? And you can avoid clash, right, with the dominant firms at home. You can also build your customer base, and also build formal relations with formal institutions. At the same time, given all these advantages, for the late mover also there are advantages, right? Whatever ecosystem that the first mover has created, the late mover can actually enjoy that ecosystem, the return on those ecosystem related investment, right? And they're much more certain about the business as compared to the first mover, because they know that it works, there is a business case, so they are more certain about the success of it, right? and they can adapt to market changes much better as compared to the first mover, right? So you see a lot of startups actually displacing the traditional big old school companies because of these late mover advantages, right? Now the where and when is done. Now the third question is about how to enter. So one is again, what magnitude or the scale, which is the level of investment, and what is the entry mode, which is how do you enter, the method of entry, right? So these two are the parameters within how to enter. Now, and we have seen this before. This is similar to the previous chapters that we have covered. Some of the previous chapters that we have covered, there can be an equity and a non-equity mode, right? Basically, equity mode is basically the FDI route. The non-equity is more to do with contractual mode, and there is a very good table here. Yeah. So this again is very important from an exam point of view. So the choice of entry can be basically a non-equity or an equity. Equity is the FDI. We have studied FDI in detail, right? The non-equity can be export, direct, indirect, which we saw in the last chapter, right? The export can be direct, indirect, right? And then there can be contractual agreements. Again, we saw this licensing, franchising, right? It can be simple turnkey projects, which is basically you have a contractor in the other country which you want to enter. The contractor builds the entire operations and provides it to you in a running condition. That is the turnkey project. It can be simple R&D contracts. So classic example is Bosch, for example, has an R&D in India as well as in Germany, right? So it's a kind of an R&D contract setup, right? Then it can also be co-marketing. So you don't have a manufacturing setup, you don't do anything except marketing, and that too using the local agencies, marketing agencies or local brands, maybe under the name of a particular brand, right? So a lot of insurance companies do that, right? You'll see Max Life Insurance, your SBI Life, right? These are co-marketing companies. In the FDI, there can be joint ventures with the local companies of that market, right? India used to have a lot of joint ventures. Maruti and Suzuki. Maruti Suzuki was a joint venture. Hero Honda was a joint venture. So that was in the license Raj, right? And then slowly they are now individual companies. Maruti is separate, Suzuki is separate, then even your Hero is separate, Hero Motocorp, and Honda is separate now. So there can be minority, majority, or 50-50 joint ventures, basically the level of stake that they have, right? And these are termed as strategic alliances. Again, to understand before entering full scale, what is the nature of the market, right? Then you can also buy companies. You can have your own subsidiaries. Like we discussed before, if your company says, XYZ India Private Limited, which means it's a wholly owned subsidiary of your parent company, right? So these can be acquisitions, like Walmart acquiring Flipkart. These can be completely new setup. So Amazon entering India like in its own way. So that is greenfield. So this is the kind of how to enter, entire set of options. Any doubts?
Yes, I just wanted to ask who will take these decisions, like how to enter a market, like the board of directors or any manager.
Yeah, so good question. So these are very, very strategic and long-term decisions. So it is generally driven by the executive leadership of the committee of the company. The board of directors have to approve it if it is a large-scale investment. And also at the same time, this is all internal. Even the government or the legal entities have to approve it, right? So there is an internal formal approval as well as externally you have to approach, and you have to get those approvals for entry. So both impact.
Okay.
Very, I would say, senior most level, CEO and investor level kind of your decisions are taken at that level. Also, most of the times, even third party, consulting companies are actually given these assignments, right? You have the McKinsey, you have the PCG, PwC. They are the ones who evaluate and recommend, and that recommendation goes to the board of directors or the CEO, and then that is where it starts. Then the evaluation is done not even within the company itself. Right? So here, this table is again an important table from an exam perspective also. There are both advantages and disadvantages to the equity and non-equity modes of entry, and we touched upon some of these. So when you are talking about direct exports, right, you have a better control, right? Obviously, because you are the ones who are doing it, right? But at the same time, there are disadvantages because you have to manage the end-to-end chain, right? You have, although you have control, but you also have all the responsibility, and to achieve the targets, to manage government, formal and informal institutions. So you have to spend a lot of time and energy, right? Whereas in indirect exports, you just focus on your competency, which is you produce what product or service you are expert in, right? You are completely out of that process of export per se, right? The disadvantage is you don't have any visibility into the other country operations. Then, in terms of the contractual agreements, again, if you see, for example, any of the like McDonald's or something, you can say the advantage is you can do that instantly. And the one of the famous quotes is that every 8 seconds there is a McDonald's which opens, right? So the development costs are low, and you have less exposure to the market. Actually, you have very limited exposure. You don't really have to manage any operations. You're just getting your royalty or licensing fee, right? You see Microsoft Office, they don't really care about what is going on in business. They are just giving out licenses, and they are earning that license fee, right? But at the same time, there are a lot of disadvantages, very less control, right? You can actually MS Office can come across a lot of competition. Google Docs, for example, although not as well adopted, but still there are. So the visibility, the control reduces when you're talking about licensing and financing, right? Then you have the turnkey projects. Again, turnkey is something which is relatively a short return and minimum risk, right? um, but again, if you are doing a turnkey, why not others? The others can also do a turnkey project, right? Similar for R&D contract again. So you'll find the common theme where you are continuously focusing on your core competency, but you are on the other side, you are also giving up more and more control and coordination and visibility. So you have to balance it, right? So that's where and they have given these classic examples also. So you can also associate, for example, Amazon, right? They entered directly into India, right? So they have better control. They are managing their marketing, their distribution center, entire operations by themselves. The positive thing is they have full control, visibility, everything. But the negative, or not the negative, but I would say the cost is that they have to do everything, right? The parent company has to spend a lot of money on Amazon India to keep it competitive within the e-commerce environment. So there are both sides to it. Whereas McDonald's, you see, is a franchisee, right? McDonald's doesn't come here. It's a franchise of the McDonald's that we go to, right? Yeah. So uh, you can just go to the table. It's generally on the level of control, the level of visibility, and the level of focus on your core competency, which is what are the factors on both sides, advantage or disadvantage. Okay, the whole thing is that how much risk, what is the magnitude of the investment you are willing to do, how much is the risk you are willing to put in the market, and what is your horizon of return, what is the competitive environment in the country that you want to enter, and what are the formal and informal institutions that you have to deal with. All those things put together is what these options come out of that. Okay. So you would have seen the nice road here in Bangalore, or any toll road. So that is a classic example of a turnkey project where a private company makes the infrastructure, builds it. It also operates it for some time and then transfers it to the government, right? So you have the toll collection, which happens on the nice road, or there are other toll roads also. So that is a classic example of a turnkey project. Okay, it government doesn't have the expertise of building roads, so they hire experts, they get them to build it, operate it, and then they take the transfer to themselves for a period of time, right? Co-marketing is like we discussed, it's about using the local agencies. So they have given a classic example here: McDonald's campaigns with movie studios and toy makers, airlines such as One World and Star Alliance. So McDonald's, whenever some movie releases, they come out with some those toys, which you can get from a McD meal, right? So that is a classic example of co-marketing. So it gives them local relevance in the audience, right? Joint venture is basically between two companies. So where you see two names put together, like Hero Honda, is a joint venture. Two different companies coming together to form a new entity, right? Wholly owned subsidiaries is where the parent company keeps the name and then buys, either buys the local company in the market, or establishes its own operations with its own name. So Amazon India Private Limited is a wholly owned subsidiary of Amazon, which is in the US. Greenfield is generally mostly to do with manufacturing, right? Where a fresh investment is done, a new factory is established, or a completely new facility is built right from the acquisition of the land itself. So entire process starts from the beginning. That is a greenfield operation. Yeah. So like there is liability of foreignness, there is the country of origin effect also. So if you have the name, American Tourister versus, I don't know, maybe, Italian Tourister, you would say, okay, American Tourister might be better because there is that branding of American, right? There is a company called American Standard in itself. It's a, I think, a hardware company or something, a plumbing company maybe. So you have this country of origin effect, as well as the liability of foreignness. Yeah, these are some I would say examples of, this is 2004, so quite old example, but some of the global companies, out of which this one is kind of not visible now. So yeah. um, so again, as managers, as leaders, what do you do, and when you have to enter the market? So you have to ask this question: where do I enter, when do I enter, how do I enter? That's what we have seen. The entire thing is to manage risk. to understand whether the mode of entry makes it feasible for you to do a full-fledged business. You can just go test the water with minimum entry, like maybe just license some of your IP, or maybe just do a joint venture. And if you are very sure, if you are a late mover, not a first mover, you can completely set up your own. See, Amazon is a late mover in the Indian market, right? uh, Flipkart is the first mover. Amazon might have enjoyed certain advantages, right? So like that, you have these factors to be considered and make decisions. And as Jaideep said, these decisions are or asked these decisions are not day-to-day decisions. These are very, very high level strategic decisions, and they are done for a very long term, right? So a company will not just say, okay, I'll invest in this country one day, and then the next day it cannot say, no, no, I will not. General Motors, it exited India, but General Motors is the automotive company, but it tried for a few years before exiting India. And the decision to exit India was also very unique, where all the global brands are coming to India. It decided to exit. You have a lot of models of General Motors available, but it was not able to compete in this environment, so it decided to exit. Any questions?
No, sir.
Okay. Today has been quite a you know relatively more silent session, and maybe faster also. So we have actually completed um, 7, 8, 9, 10, 4 chapters, and we have a good 1 hour, right? Let me get to. So do you want me to cover one more chapters? One more chapter? Generally, it's a little more interactive class, so that's why I'm a bit surprised also. I think we are also meeting after 3 weeks, so that is another thing. But what do you suggest? We have covered 4 chapters. We have 5 more remaining and 2 sessions, so we can comfortably cover it in the next 2 sessions also. So that's not a question.
Yes, sir. Next 2 sessions we can complete it.
Yeah.
And assignment too. So when it will be uploaded in?
It's available.
Okay. Okay.
Yeah, yeah, it's available. If you're not able to access it, please, talk to Arvind, because it's been uploaded for more than I think 10 days now.
Okay.
So you can do that. Yeah.
The last day for us deadline for that assignment too is in September, right, sir?
Yeah. I think even that, I mean, there will be a clear communication from the associate dean, also Professor Rajan. But yeah, you can keep maybe 2 weeks of time as a, I mean, proactively, so that you don't need to rush. Okay. Anything else? Any global news? So recently, Turkey has they have found a large reserve of natural gas and oil. Are you aware of this?
No, sir.
Yeah. So Turkey has discovered in its um, basically in its geography, in its governance area, I think within the sea, one of the largest sources of natural gas and oil. And this will change a lot of dynamics of the way Turkey is treated, and the way Turkey will treat other countries, right? Turkey is more aligned to Russia as compared to the West. Um, it is also not very much uh, friendly nation for most of its neighbors. So it will be interesting to see uh, how. In fact, it was at one point of time almost it got into European Union at one point, but then it started buying weapons from Russia. That's where it couldn't enter, or that it slowed down the process of entry into European Union. Okay, I think then if there are no further points, maybe we can then you know uh, end the class. If there are any doubts, clarifications on assignments or anything, you can let me know. Otherwise, we can cover the rest of the uh, sessions, rest of the chapters in the next two sessions that we have.
Yes, sir. Sure, sir.
Okay,
I-
sir.
okay. So then see you in the next session, and have a good weekend. Okay. Stay safe.
Thank you, sir. You too.
Thank you, sir.
Yes, sir. Same to you, sir. Happy week.
Thanks. Bye.